If the first phase of petrodollar pressure is diversification, the second phase is fragmentation, and fragmentation changes the rules of the system. Over the past decade, sanctions policy has expanded dramatically. Financial sanctions, trade restrictions, asset freezes, exclusion from payment systems. The modern financial system has become a tool of geopolitical leverage. In the short term, this strengthens the power of the dollar, but in the long term, it creates incentive to build alternatives. When large economies experience exclusion from the dollar system, they begin constructing parallel channels. Russia accelerated ruble-based energy settlement after sanctions. China expanded cross-border yuan settlement systems. India explored bilateral clearing mechanisms. None of these individually rival the dollar, but together they form infrastructure. Infrastructure does not need to replace the dominant system immediately. It only needs to exist. Because once alternatives exist, countries have optionality. And optionality changes negotiation power. Now consider BRICS. Originally a symbolic grouping, it has increasingly positioned itself as a counterweight to Western-dominated institutions. Expansion discussions, trade settlement cooperation, development bank initiatives. Some policymakers have floated the idea of a shared settlement currency. Whether practical or not, the signaling itself matters. If even 10 to 15% of global commodity trade shifts outside dollar settlement, that represents a measurable structural change. Not catastrophic, but meaningful. Now, let's layer in digital currency infrastructure. Central bank digital currencies, or CBDCs, are being developed across major economies. China has advanced pilots. The European Central Bank is exploring digital euro frameworks. Emerging markets are testing cross-border payment systems. Digital settlement reduces reliance on traditional clearing networks. Reduced reliance weakens structural gatekeeping power. Again, this does not mean the dollar collapses, but it means friction points increase. If sanctions accelerate alternative system development, a financial bifurcation risk emerges. Two partially overlapping systems, a dollar-dominant bloc and a diversified settlement bloc. Even partial fragmentation increases inefficiency. Trade becomes more complex, liquidity pools split. Currency volatility rises, and volatility feeds into investor psychology. Markets dislike fragmentation because fragmentation reduces predictability. Predictability supports risk-taking. Reduced predictability increases hedging. Increased hedging increases cost. Cost slows growth. Now ask the deeper question. What happens if geopolitical competition intensifies while energy markets remain central? Energy remains strategic, commodities remain political, trade routes remain contested. If energy exporters begin pricing oil in multiple currencies, reserve managers adjust portfolios. Reserve adjustments influence bond demand. Bond demand influences fiscal stability. Fiscal stability influences global confidence. The chain extends outward. In a fragmented environment, currency blocks may emerge. Energy exporters align with one settlement system. Importers diversify across multiple. Trade agreements begin embedding currency clauses. Over time, liquidity pools deepen around alternative currencies, not because the dollar disappears, but because alternatives mature. And once mature, they reduce monopoly. Monopoly in currency markets creates structural advantage. Reduced monopoly creates competition. Competition creates volatility. We are not yet in a fully fragmented world, but the architecture for it is forming. Bilateral trade settlements are increasing. Commodity exchanges are experimenting. Payment systems are diversifying. Each step small, but cumulative. The most important signal will not be rhetoric, it will be behavior. Watch reserve allocations. Watch sovereign wealth fund diversification. Watch commodity exchange volumes in non-dollar contracts. Those data points reveal trajectory. If fragmentation accelerates, the transition period becomes the most volatile. Transitions between monetary regimes are rarely calm. They involve uncertainty, speculation, policy reaction, and markets amplify uncertainty. The risk is not immediate collapse. The risk is instability during adjustment, and instability in highly leveraged systems can magnify beyond its origin. This is the stage where narratives become powerful. If headlines begin framing events as the end of dollar dominance, capital flows could overreact. Overreaction leads to sharp moves. Sharp moves force central bank response. Policy response then becomes the stabilizer or the accelerator. Which brings us to the final question for this segment. Is the world moving toward currency competition or toward controlled diversification? Because the difference between those two paths determines whether the shift remains gradual or becomes disruptive. Let's now examine the scenario that markets rarely model directly. What if the petrodollar does not collapse, but weakens enough to change structural flows? Not 5% diversification, not symbolic experiments, but a sustained, measurable reduction in dollar dominance in energy trade. What would that mean? First, U.S. Treasury markets. For decades, recycled petrodollars helped reinforce demand for U.S. government debt. Energy exporters accumulated dollar reserves. Those reserves were invested in treasuries. Treasury demand supported lower borrowing costs. If that recycling loop softens meaningfully, the marginal buyer changes. Domestic institutions must absorb more issuance. Yields may need to rise to attract capital. Higher yields increase interest expenses. Interest expenses increase fiscal strain, and fiscal strain becomes visible in deficit projections. Now consider inflation dynamics. If the dollar gradually weakens relative to a basket of currencies, import costs may rise. Energy, commodities, industrial inputs all become more expensive in dollar terms. Inflation pressure reemerges. The Federal Reserve then faces a dilemma: raise rates to defend currency credibility, or lower rates to support growth under fiscal pressure. Policy trade-offs intensify. Now think about equity markets. For years, U.S. equities benefited from global capital inflows. If global reserve managers diversify away from dollar assets, capital allocation patterns shift. U.S. markets remain large and liquid, but marginal inflows slow. Slower inflows reduce upward pressure on valuations. Multiples compress. Volatility increases. Not necessarily a crash, but a recalibration. Meanwhile, commodity-producing nations gain leverage. If energy trade becomes more multipolar, pricing power shifts toward exporters. Currency competition increases volatility in oil markets. Volatile oil prices feed into global supply chains. Supply chain instability affects corporate margins. Corporate margins influence equity pricing. The effects cascade. Now consider emerging markets. Some benefit from reduced dollar dominance. Others struggle if fragmentation increases borrowing costs. Capital becomes selective. Liquidity pools become uneven. Financial centers compete for settlement relevance. And in this environment, confidence becomes the most valuable asset. Because currency dominance ultimately rests on trust. Trust in liquidity, trust in legal systems, trust in political stability. If global investors begin to question long-term U.S. fiscal sustainability, even slightly, risk premiums expand. Risk premiums affect mortgage rates. Mortgage rates affect housing. Housing affects domestic consumption. You see how the chain extends. The petrodollar was never just about oil. It was about reinforcing a system. If that reinforcement weakens, the system does not collapse overnight. It becomes more sensitive, more reactive, more volatile. Now ask yourself, is the United States powerless in this scenario? Not at all. The U.S. still controls the deepest capital markets in the world. It still leads in financial infrastructure. It still has military reach and technological influence. But dominance with competition is different from dominance without it. Competition forces discipline. Discipline forces reform or exposes weakness. The most realistic outcome may not be a dramatic dethroning. It may be a gradual transition toward a multipolar currency influence. In a multipolar system, no single currency absorbs all global shocks, but fragmentation increases coordination difficulty. Global crises become harder to manage. Central bank swaps become more complex. Liquidity lines require negotiation. Political alignment becomes financial alignment, and during moments of stress, alignment matters. The real risk in a weakening petrodollar system is not immediate collapse, it is instability during transition. Transitions create uncertainty. Uncertainty creates volatility. Volatility tests resilience. If global leverage remains high, and it is, volatility amplifies quickly. So, is the petrodollar dead? No. But is it unquestioned? Also no. And history shows that once structural questions emerge, systems rarely return to their original form unchanged. We are likely entering a decade where the dollar remains dominant, but contested. Energy remains central, but diversified. Financial power remains concentrated, but challenged. And in that environment, market behavior becomes less predictable. The most important shift is psychological. When investors believe a system is permanent, they allocate confidently. When permanence becomes probability, hedging increases, and hedging reshapes capital flows. The next decade will not be defined by collapse. It will be defined by adjustment. Adjustment in reserve policy, adjustment in energy pricing, adjustment in fiscal strategy, adjustment in political alignment. The petrodollar system shaped half a century of financial history. If it evolves meaningfully, the next chapter will not look identical to the last. And the markets that thrive in this environment will be the ones that understand structure, not headlines. If this series helped you see the deeper architecture beneath the phrase petrodollar dead, subscribe. Because the most important financial shifts of this decade will not arrive with dramatic announcements.